Good morning, traders. Chris Buss here with Traders Profit Compass with another edition of Before the Bell, your home for actionable pre-market content. It is Wednesday, May 4th, 6:55 a.m. as I'm starting the video. And as always, please run your player at 1.5x for maximum efficiency. Let's take a quick look at futures and what we got on the board for today. Oil's up 4% on news that the EU is proceeding with plans to ban Russian oil and refined products by the end of the year. Stocks generally are up about 0.4. Nat gas is over $8 again. Precious metals are mostly flat. Of course, today is the big day on the macro front with Jay Powell front and center at 2 p.m. Eastern time with the press release, and then the press or interview portion of the Fed announcement at 2:30. All eyes are going to be on that. On the earnings front today, we've got Moderna, CVS, Barrick Gold, Uber made an interesting move last night after seeing Lyft's disaster report. They moved their earnings up from 4 p.m. to 7 a.m. to kind of preempt a sell-off. After the bell, we've got Etsy, Marathon Oil, Twilio, CF Industries, and the fertilizer group, and Apache. Some big movers overnight. We've got Livent, which is lithium, ticker LTHM, up 23%. We've got Scott's Miracle-Gro and Paycom up 7%. Lyft, on the other hand, is down 27%. Herbalife down 15%. Akamai down 15%. Revolve Group down 10%. AMD, I don't have the percentage, but I think they're up about $8 after their report. So a lot of stocks on the move here this morning. So what I want to do is kind of set the table of where we're at on the charts. I think there have been some fairly interesting developments that I want to share with you heading into the Fed. We'll run through our indicators, the indexes, and the FATMAAN names, and then what I want to do is share a little bit of my thoughts on the FOMC statement. So starting here with our extremometer, you can see here the histogram bar for yesterday. More call buying, not as much put buying. You can see that we've popped up above this level here, the level that below which signifies extreme put buying, and you can see that we had really about a week-long cluster of put buying in this area, and then yesterday we kind of broke that trend by breaking back above. When we jump over to the oscillators, I mean, we've been up the last couple of days. I mean, not dramatically, but higher. So the oscillators have relaxed. We got down here into the low 50s, and now we're up into more of the midpoint of the range. So they're not really going to be too helpful. Same thing with the NIMO here at minus 23. Really isn't predictive. Can go. It can do a moonshot from here, or it can go back down below 60, minus 90, back in that area. So really didn't get what I was hoping for, which was a real capitulation low, where we could say, okay, man, the rubber band's really stretched. We can exit all our shorts and position for a long. It was kind of a I don't want to say a wimpy bottom, but there really wasn't that waterfall type look that I was hoping for. And, a lot of times you don't get what you're hoping for. So, and we can see it here on the VIX. We had that high up towards 37, and it just couldn't hold it. So VIX has collapsed down here to 29. Now, that 29-30 area, you can see back on the charts, has been kind of an important regime level here. Watch that this afternoon. You may get, well, who knows what we get, but a decisive break below 29 would certainly be bullish, and anything back up above 30 would certainly be cautionary. If we look at the volatility term inversion, we're still down at the low end of the range, meaning still some fear in the market. We're not this particular term, the 3-month versus the 1 month, you can see has lifted, where the ultra short term 1 month versus 9-day is still down here in the extreme zone. So we don't have really anything definitive on the indicators that we're following to do this or do that. Really, and to think about it, that's kind of what you'd expect before the Fed. There's just a lot of event risk there. You could probably tell in the recent couple of days we've gone higher, but it hasn't really been impulsive or decisive. I would just call it kind of like a wandering move. Nobody wants to really step in on the short side or the long side ahead of the Fed, ahead of that event risk. And I'll have more on that as we move along this morning. So here on the SPY daily, we took that look below down to 405 the other day, and then we put in a hammer candle and have popped up above 415, which is important. Why? Because those were the March lows, and 410 was the February low. So I would be keying in on 415 and 410. As long as price can stay above 415, that is near-term bullish, a check mark for the bulls. Really, to get things going to the upside would be a break back above 425 to recapture this big breakdown candle and get back up into this value zone here. You can see that the volume over price bars really extend once you get above 425. So that's where the going would get a lot tougher when price got up to that point. So that would be a level that I would have fairly highlighted in your on your charts. Here it is on the 60-minute chart, and what I've done is dropped in a rough trend line off of the top down through this recent price action, and you can see that aligns pretty well with what we were just talking about. We've got, here was our low, here is the February low, here at 415 is your March lows, and so now we're marginally above it. We've got a line here at 420, 422, and then a breakout above this downtrend line would be rather important, I would say, in the whole scope of things. And here's something that I want to point out, and I've probably been negligent in recent days by not pointing it out. But notice the bullish divergence. Here on price, we've got a series of lower lows, but under the surface, momentum has been higher. That's bullish divergence. And RSI has been higher under the surface. So that's your bullish divergence. And in a bull market, that's what you want to look for in a dip. When you find, in the past when we've had those dips down to the 50 EMA and other dips along the way, and you see bullish divergence, those have been golden opportunities to buy, because 90% of the time they panned out. Now, what's going to be really important today in the days ahead is watching if these bullish divergences play out or if they roll over. Because if we are truly in a regime shift, there's a high probability that these bullish divergences fail. Just like in a bull market, there are a lot of bearish setups where you have a higher high, but the indicators are lower. That's how, bearish divergence, the opposite of what we have now. And those bearish divergences fail. They get burned through, and we go on to make higher highs. Now, in this situation, what you'd expect to see is, just taken on the face of it, you'd expect a breakout. We put in a divergent low. We've got bullish divergences. This breaks out, and everyone lives happily ever after. So that is something to watch as we come out of the Fed meeting. Jumping over to the QQQ, we had our marginal new low here. We took out the March and February lows at that 1735. I've drawn in, actually this should be, it's not support anymore, it's resistance. So that should be shaded red. Sorry for not catching that and doing that. But I think job one for the bulls is to get price above 322-ish and hold it. If there's a pop-up, notice where the declining moving averages come in. Where we had a touch of the 8-day really over the last we had a touch yesterday, we had a touch here, and we had a touch here, and all of those touches have been rejected, and really we've been below the 8 EMA ever since back here towards April 18th, and just a brief moment above, and you could really make a case for this breakdown candle here back towards the 1st of April where we lost the 8 EMA. It's really contained price the whole way down. So job one would be to recapture this 322 area, get above the 8-day and hold it. If it pops above and then fails, very bearish. And then you can look at the resistance levels on the way up. You've got a level here at 330, which by that, the 20 will be coming down. So that'll be a next layer. And then this 339 area where the 50 will be coming down will be an area of lateral and EMA resistance. So the bulls got their work cut out for them because you've got full bearish stack on the EMAs And at each technical level, you've also got the EMA, the declining EMA coming in as acting as resistance as well. So there's a double layer of resistance, if you will. But here again, notice we've got the same setup as we do on SPY. We made a lower low, but we made a higher low in momentum, and we made a higher low in RSI, setting up bullish divergence. You'd expect that to play out if things were going to move higher. So that's cautionary for bears. So we'll have to see if that bullish divergence indeed plays out, or these indicators roll over, break these trend lines, and then thus burn through the bullish divergence and then set up for a lower low. And you can see, very well defined downtrend, series of lower highs and lower lows. We are still within the channel, and that channel comes right in at 322, 322.50. So a break and hold above this level would set yourself up for what could be an impulsive and significant rally. Now, I don't know if you follow FinTwit, Twitter, all your social media. Everybody and their brother are calling for a relief rally. It's the easy thing to do in a situation, like this. Everybody wants to be a hero. And when you hear somebody says, "Oh, there's going to be a relief rally," your next question, are you long? And how long are you? Because you can say, are you, I'm bullish. It's time for a relief rally. But if you're not long, it's nothing. It's just conversation. Likewise, you can say, biggest bear on the block, what names are you short? And how short are you? That's where the rubber hits the road. So always think about that when you hear pundits say, oh, this or oh, that is going to happen. Ask them what their position is, and then that'll really, really clarify it. IWM. Look below the range, recaptured the range. That is near-term bullish. Does it have work ahead? Yes. Still below the 8-day. Still have a full bearish stack. But bears got to be careful here because the price broke back up into the range. And here again, we have bullish divergence in place. Notice a series of equal lows, if not a marginal new low, but at higher momentum and higher RSI. I don't like seeing that. Here it is on the 60-minute chart. New low, but at higher PPO and higher RSI. So today, I would be looking at this 191.50 as an important level. That's where it got rejected the other day. That's where it had trouble back here. You had prior lows at 191.50 back here in March, and you had a spike low down to 188 here. But then in the following day's action, you can see that at 191.50, that was a price that was probed a couple of times on IWM. So the stage is set across the board on the indexes for a pop with those bullish divergences. Facebook has been doing well. got the gap up on earnings and has been going higher. If you played your bracket trade, that's been working. And I think across the board, when you look at, the various stocks in the market, the ones that have really re-rated, and what I mean by that is, the valuations have really, really come down. They've been doing marginally better. When you look at Facebook, it got cut in half. It went from 360 to 180. That's a significant re-rating. So then it puts price in a whole different perspective. And I mean, their earnings report on the face of it was really not that impressive. But when you put it in the context of a company that's been cut in half, it's in a little different light. So when you're sizing up or looking at companies that you may want to do something with, I mean, I'm not a big fundamental guy, but looking at a long on a stock that's been cut in half that has positive technicals, then that's a big plus. Apple has not re-rated. It's fallen a little bit, but nothing like a Facebook. So, here we are, marginally above the downtrend channel as I have it. I would just key off of 159 to really get going. It's got to get back above this 163.50 and then, kind of grind its way back up. You see a breakback below this downtrend channel, getting into the 158s, 157s, 156s, and making its way back down. That would not be very inspiring price action for the bulls on Apple. Tesla, rising PPO, rising RSI, higher lows. We had a higher high here. We have a bull flag here. So if we look at these levels, I think taking out this high right here at 935 would be an important level, and holding this 905, 900 area is going to be an important support level. Below that, you probably roll down to 880. Above 935 opens up the door to 980 on Tesla. And if we jump over to the daily chart, notice that we've recaptured the 200, and that was a point on the chart that we said you really wanted to toggle off of. So as long as price holds the 200, and you want to be long Tesla, I think that remains your no-go level on Tesla. Microsoft had the gap, had the two runs up to 290 where we said very objective shorts. Both of those worked. You got essentially an $8 move on the first one. You got a $10, $12 move on the second one. And, this is pretty unusual price action, going into the gap and then, not proceeding to fill it, but regaining composure and then breaking back above. I've dropped in a little uptrend line, series of higher lows, which is short-term bullish. I think as far as trading it, as long as it holds 280, I think you're all right on the long side. Given that this really hasn't broken down for that fill, I would be very cautious if price got below 280 and I was long. You'll have to, set your objective stop, wherever you feel comfortable below 280. On the upside, I mean, this 290, 291 has been the wall. So unless it can get above that, I mean, you can consider that a nice short-term type trade. I mean, to go from 282 to 290, if you got that in a day or two, I think you'd be happy. But longer term, it's got to crack this level and fill this gap before it's really more than anything but noise. But again, here, notice there was some bullish divergence in place. We had a series of lower lows here, but momentum has been increasing. So at this low here, down at 270, it was a divergent low because you had PPO at a higher level. Now, Amazon is another one of these companies that's re-rated. We were at 3,400 a month ago, and now we're at 2,400. So just in that amount of time, $1,000 has been taken off of Amazon. So fundamentally, different picture than up here. So now, keying in on the prices, you've got a resistance level here at 25.50. I think if it can break above that, you can get a door up to 2,600, and then 2,650. Your free 50 club on that breakout. You've got an opportunity for a quick 50 up to 2,600, then 2,650. On the downside, you've got a level here at 2,450, and then a level here at 2,400, the prior lows. You break the prior lows here, and then, that opens the door for more selling. To a certain extent, Google has re-rated as well. We're 500 off the highs. Notice the bullish divergence. We had a low here and a low here, putting in a double bottom, but with increasing momentum on that second low and increasing RSI as well. So there you go. Your double bottom low with bullish divergence is usually gold, but that's in a bull market. If this fails, then that'll be a check mark for the bears of burning through bullish divergence and going on to make a lower low. Now, when would this trigger? It would trigger on a breakout of this downtrend line, which is a pretty nice one. I mean, there's not a lot of touches, but it comes in at the right place at this 23.75. And so let's see, that's $125 wide. From 22.50 to 23.75, you get that breakout. Your measured move target is 125, and that would put you up here towards, what would that be? Yeah, 2,500. 125 on to 23.75 puts you up at 2,500. So that would be your measured move target coming out of this double bottom consolidation. So look for that on the long side if you get that breakout. If it makes a marginal new high, then rolls back down, then your target's back at the bottom of the box. Netflix has re-rated as well. I don't even know how many hundreds of dollars it's been down. I think it's, well over 50%. Way down there. We haven't really seen a big price reaction, but maybe this is just building a big base. Personally, for me, I just have this 187.50 and 210 alarmed. I don't really want to mess with it in here. You trade it as you like, but you can definitely tell the different key levels on this chart. You've got a consolidation zone here, you got the initial breakdown zone here, and then you've got the big $100 gap. Semis, another bullish setup. Double bottom, bullish divergence, higher lows on RSI and higher lows on PPO, while you are making an equal low on price. So I've got the measured move here. A breakout above 240 has your measured move up here at 255. So keying in on 240 is going to be really important. That's the key level in the days ahead. So let's talk about the Fed. The baseline assumption is that 50 points now, 50 basis points, 50-point rise now, and 50 in June, and a $95 billion a month reduction in the balance sheet QT starting in June. Now, everything is going to be on what he says, on what Powell says. His credibility has been hugely damaged over the past year, clinging to the inflation is transitory way too long. Of course, this is all in hindsight, so, it's a lot different taking pot shots from the peanut gallery versus being in the chair. But most people agree that that was a policy mistake and that he should have been, while the economy was raging last summer and into the fall, he should have been starting to raise rates and take the market off of the, the heroin stimulus. Now, you probably saw that first quarter GDP was negative. So the fear is that they're tightening into a slowing economy. The things to listen for are, what does he say about the economy? Is the economy strong, or do we see signs of slowing? Do they go 75 basis points today? Do they say, well, we're gonna do the 50 basis points today, and we're gonna do 50 basis points in June, but we're gonna hold off on the QT? That would be dovish. You'd probably get a moonshot on that. So, but at the end of the day, it's a flip of the coin. He could say exactly what everybody expects him to say, and the market craters, or the market does a moonshot. It is a flip of the coin. And I'll tell you that just over the last few days, taking into consideration, all the bullish divergences that I see, I was heading into the week thinking, I've got bearish position. You know the positions that I have. I was short ARC. I covered those yesterday. I'm short, what am I short? Industrials, IWM, consumer discretionary. What were the other ones? Those were the big ones. IWM. Oh, just XRT, retail. And I was very comfortable in those positions out in June, figuring that we would, roll over and head lower. I still think that, but with the divergences, all the divergences that I've seen in place, my conviction short term is much more moderated. And what I think I'll do is lean on the idea that discretion is the better part of valor. I could be right in the end and have the market roll over, but that doesn't mean that there can't be a 2-week moonshot in the meantime that would hurt me, hurt the P&L quite a bit. So what I'm going to do is take down risk ahead of Powell, say, you know what? Truly anything could happen. Moonshot, crater, something in between. We know from past experience that the first move is usually fake, but defining what fake is not really all that easy. Let me give you a for instance. We rocket up higher after, the first 15-minute bar is a moonshot. And then it starts rolling over. Well, you say, oh yeah, the first move was fake. It went down. But it's all on the time frame that you're trading, right? If you're a swing trader and price goes up 8 or 10% and you're short, it could eventually roll over, and then you look back on the chart and say, see, the first move out of the Fed was fake. That might be true, but all your positions are underwater while you're waiting. So that's my point. Whether it goes down or up immediately after the Fed is besides the point. It's how much risk do you want to take into that event? Just like I was going back to, all these guys calling for a relief rally. That's great. I mean, you got a 50% chance of being right, but how much money are you willing to put on the line for a coin flip? And for me, I've always taken the approach that job one is preserving capital. Job two is trying to make money. And if you lose a lot of capital on the way to trying to make money, then it's going to be obviously more difficult to grow your account. So what I'm going to do is ratchet down risk heading into the Fed. We'll see today, do people get panicky ahead of the Fed and sell? Take it down before the Fed announcement? I'm going to wait and see. That would be great for me because the puts that I have in place will gain value. We're up a little right now. If it looks like we're going to rise into the Fed, I'm going to pull the ripcord on those shorts early. If it looks like we're going to head lower, then I'll wait longer and then right right before the Fed, exit those positions, and then pick up the ball later. Really, I think it's going to take through the end of this week to kind of really know, and into Monday, kind of really know how the market digested all that. There's going to be a lot of noise after the announcement this afternoon and into the presser. We've seen instances where, there's a moonshot on the release, but then it starts fading. The more he talks, the more it goes down, or the other way, a down bar and then go higher based on his comments. So don't take too much out of that whipsaw action coming right out of the press release at 2 o'clock. Watch and see what it does while he talks, and then I would probably be hesitant even tomorrow, going big either way. Maybe, put a toe in, either long or short, depending on what I think, but then have more, a little more conviction early next week on, based on the levels and all our technical analysis and stuff like that, kind of how to position, for the back half of May and into June. So I hope those comments really helped. I hope you're keeping your wits about yourself and you're trading well. On the blog this morning, I have a little thing about emotional drawdowns. I think you should take a look at that. We've all been through those. And if you're in the midst of one, definitely take a look, because this market has not been easy over the last 4 or 5 months. Really choppy. You can't not turn on the news and hear about the 60-40 portfolios that have been decimated, with stocks and bonds both going down at the same time in dramatic fashion. So take it with a grain of salt when your FinTwit guys tell you how great they're doing, because industry veterans that have been around 20 years, trading houses that have stood the test of time over 20 or more years, trading all different kinds of cycles, say this has been one of the toughest markets they've seen and experienced in a long time. So if you're personally struggling, don't take that as a personal affront that you're a crappy trader. It is a tough environment out there, and if that's weighing on your trading psychology and your emotional fitness overall, take a look at those ideas that I've got on the blog site today. I've also got some stuff on housing and OPEC oil production. So please take a look at that. Let's wrap it up there. This has been Chris Buss with Traders Profit Compass. Talk to you next time.